We're here to talk about the Silicon Valley real estate marketplace being updated on Saturday, May the 16th through Friday, May the 15th. Here's the summary slides that we're going to be going to, the key chapters and the estimated duration of each. This is the controlled page that we'll get back into in a few minutes. I'm Richard Calhoun, real estate broker with Creekside Realty. Let's get into the first summary slide. This is simply looking at the volume of offers accepted for the past 1, 2, 3, and 4 weeks. The solid line is the current data. The dotted line is the 10-year median. You can see that all the solid lines are below their corresponding 10-year median, but that's because we've been missing about 20% of the marketplace ever since 2022. In 2023, we missed about 30%. In 2024, 25, and 26, we're missing roughly 20% of the number of transactions, offers accepted. It's following the normal pattern. There's been no slowdown because of the tariff. There's been no slowdown because of the Iran war, both of which have surprised me. But this is to give us early warning signs. Last week, if you listened, I was hesitating because there was 2 weeks of lower number of offers, but I've updated it, and I go update back for 13 weeks, a full quarter, because it's a live database. And now there's no indication of a slowdown whatsoever. It's following the absolute normal pattern. Here is the summary slides of 7 key indicators. The turnover rate we talked about. The gray line is the typical median based on the past 10 years. The red is the number that would be the most you'd expect or the least you'd expect to favor, that always favors the seller. And the blue line is the line that favors the buyer. That's defined as either the 10 or 90 percentile, depending on whether you want more or less. So right now, you have 35% longer turnover time, and it's 44 days. Anyway, you have 44 days to turn over the marketplace one time. That's 35% longer than it typically is. Your marketing time is 22 days, 42% longer than it typically is. Your price reductions, this is how much the seller reduces their own ask price before they accept an offer. And this is sort of the difference between the seller's expectations and the market reality. That's actually over 2 times more price reductions than normal, and now you're over 1%. Overbidding from the buyers is at 7.5%, normally at 6.9%, and offers accepted is 85%, so you're only missing 15% of the marketplace. The inventory is 21% more inventory than you'd expect. And finally, the closed transactions. This is really not an indicator. This is telling you what happened in the marketplace 5 and 6 and 4 weeks ago. And right now it's at 79% of the volume that you would expect. I put it on here more because that is what makes the industry function. That's the number of loans that are generated. That's the number of escrows. That's the number of listing agents that get compensated and buyer's agents that get compensated. Here now is 3 key metrics over time. So we're going all the way back to January 1st of 2016. The reason I go back, that's 10 years. 9 years are on the condensed scale to the left of the vertical green line. And to the right is a full year, so you can have an idea of the scale, and then the current metrics. We're starting off on the purple line, which is the turnover time, and you can see that a few weeks ago, we were almost at 145% slower than normal on the turnover time. We're now down to about 135%, which is an improving marketplace, but still slower than you'd expect. You can see these are close to record highs. They are not record highs. We've actually had, just 2025 was higher by quite a bit than we are now, but right now we're improving. The second metric is the offers accepted. You can see you're down here at 80%, 1%, and we shot up this week to about 85%. So this was a week of strong sales, bringing back the number of offers accepted. And the third indicator on here is active inventory. You can see we got that 21% more inventory. Just a few weeks ago, right before the end of the quarter, so basically April 1st, we're talking about 45 days ago, you were 40% more inventory. So the surplus inventory has gone from 40% to 20%. Here's a summary of the market conditions. These are the different micro markets. You got Santa Clara County at the top, then San Mateo County in the middle, and Alameda County at the bottom. The ranges are down here so you can get a feel for it. Basically, you have 2 key things on here. One, and it's cut off a little bit on this slide, you have the yellow over here, the first 4 indicators. Those are your leading indicators. The orange are your lagging indicators. The green, which is the year over comparing to the 10-year median, is what I want you to focus on. Look how blue-green everything over here is. So despite the market still being a fast-paced marketplace, the left-hand side, the key leading indicators, compared to where Silicon Valley normally is, it's favoring the buyers. So the buyers are not as aggressive in everything else as they typically are, but they're still aggressive. You don't overbid 7.4%, whatever the number was, if you're not being aggressive. And, that's happening right now. Here's the control slide. I call it the control slide because you can control where you want to go. The 78-page PDF handout is out. You can hit the QR code on the top left. You can type in the long blue URL, or you can type in the shorter green root URL plus the letter H for handout, the year 2026, the month 05, and the date the 16th. That's always the Saturday presentation dates. And that will take you to the PowerPoint presentation handout. It's a PDF, 78 pages. You don't have to print it. You can just look at it on your screen if you want. To get to the meetings and participate and ask questions, which I would actually appreciate more of, hit the QR code Saturday morning at 9, type in the long blue URL, or type in the short green root URL plus just the year 2026. And that takes you right to this presentation being recorded at 9 o'clock Saturday morning. If you want the archives to go back and look at what I've done over time, you can type in the green root URL by itself, or the blue URL for YouTube, or you can hit the QR code on the left-hand side, bottom left. Again, I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. Appreciate likes and subscriptions and feedback. Here's a quick summary of some of the customization work I do. Give you commute times to different places. Have a client recently that's worried about commute time to hospitals and paramedics. Whatever it is that's important for your search criteria is what my job to make it easy for you to find those properties. Here's some quick definitions of what we're going to be going over next. Here's the first micro market graph. This is showing the turnover time in the 20 different micro market areas in Silicon Valley. Red is a fast-paced marketplace. Blue is a slow-paced marketplace. So let's look at these blue areas out here in Livermore and see what we're talking about. Livermore is 157 days, Pleasanton 131 days. Those are the two areas that are the bluest. The gray areas are outside the area of this analysis. That's Santa Cruz, San Francisco. They come into the Greater Bay Area at the end, but they're not in the Silicon Valley. Silicon Valley is made up of Santa Clara, San Mateo, and Alameda counties. And you can see that in Santa Clara County, the range is from 29 days to 61 days in South County. And I'll point out that South County and also typically Saratoga Los Gatos is a much slower marketplace. One thing that I've been notice that the expensive areas down here at the bottom of Santa Clara County are the red colors. So they're having fast-paced marketplaces, and they're from 29 to 38 days, very reasonable. As you go up and down in price, you go up turnover time. You go from 43 days to 61 days, and it's, with the exception of South County, I believe it's directly related to the price of the different areas. And you take that same concept to San Mateo County, and it doesn't apply at all, because the areas like Belmont and Redwood City are completely different. And they're roughly, well, they're not completely different. They're similar in price and they're similar days of marketplace, Pacifica. But here you have your expensive areas, Atherton being the slowest. So I can't see the trend. Clearly, the trend, might be happening in Alameda County to some degree, because Fremont's an expensive area compared to Livermore, and but Berkeley and Alameda is expensive, but it's also doing well. So there might be a price correlation. I'll actually see if I can't remind myself to do that and to look at price versus turnover time. Here's turnover time compared to the 10-year median. So the last was the raw count, and this will be the pattern. And now we're comparing to the 10-year median. Yeah, so I don't have micro markets. So now I've blended all Alameda County, and that's probably why Livermore is not showing up in bright blue. Anyway, you can see the areas down in Santa Clara County are blue. Some of the more affordable areas are deeper blue. And again, as you go up in price, you're going from deep blue to medium blue to light blue and then to pink. So there definitely appears to be a correlation. So Palo Alto and Los Altos is actually doing slightly better than normal, which is hard to believe, but you're at 80%. So you're turning over 20% faster. Saratoga Los Gatos is 20% faster. Then Cupertino Sunnyvale is 150. Santa Clara Willow Glen is 170, or the only one out of order would be, the most affordable areas, because it's not at 250%, which is what you'd expect if it was in price order, but they're at 167. The reason I'm harping on this a little bit is I noticed in the last couple of weeks, there definitely seems to be what the economists are calling the K economy, where the more expensive communities are doing fantastic, or doing equally well, or doing very well compared to where they normally are, or compared to what you'd expect them, and the less affluent areas are not doing as well. And that looks like it's almost happening in real estate as well. Marketing time. This is how long it's taking 3 out of 4 sellers to sell. Red times are pretty fast, under 3 weeks. So most of the areas are under 3 weeks. There are some green areas, like the affordable areas, at 4 weeks, South County at 5 weeks. You go up in San Mateo County, you got 7 weeks in the Atherton area, you got 7 weeks in the coast. But other than that, you're basically at 3 weeks. Pacific is at 4. And then you go into Alameda County, and you're basically right around 3 weeks, with the exception of Pleasanton, that's at 30 days, and Oakland at 31. Marketing time versus typical. This is comparing, again, the raw counts that you just saw to the 10-year median, and you can see that it's much bluer in color. You got the basic fastest one here, I think, is going to be Los Altos and Palo Alto, and it's at 98%. So it's normal. That's sort of why it's the lime green. The greens are great, slower than normal, and then you get into the blues, which are slower than the greens. So like at Atherton, 200 times. So you can see that the marketing time is quite a bit longer than typical. Now you're looking at price reductions. This is how much the sellers are reducing their price before they get the offer in. You can see that the San Mateo County coast is at 3.5%. That is by far the highest, followed by Santa Clara County's affordable areas, which are East, Central, and South San Jose, at a 2.5% price reduction. A lot of areas around 1.5%. But then there's also areas, down here at 1/3% for Cupertino, Sunnyvale, 0.6% for Foster City, Pacifica 0.6, and you go into Alameda County and you have Hayward, which is 0.6, Berkeley, call it 0.6, but then you also have areas like Pleasanton at 1%, and Oakland at 1.2%. So they're not huge numbers, and again, the reason they're not huge numbers is the vast majority of the sellers do their homework and only adjust price when they misread their mark, or sometimes they tested the market. The other thing that you have happen, which is the reverse of a price reduction, is not a fair number, but some agents are coming on the market at like $999,888, and then they're not getting the amount of overbids they were expected. And then after 2 weeks of trying their trick, they raise the price, and then they're actually have days on market problems because they've been around for a while. Some are successful in selling eventually, and some are not. Here's the reduction versus typical. So now you're comparing to normal. So again, you can see there's a fair amount of blue, which indicates that sellers are taking larger price reductions than they typically are. It looks like we might have no areas that this up here is Atherton, and that's actually blue in color. When you're on the map, sometimes, at least to my eye, this looks like it's a little bit of a pink color. I think it's more of a purple color, but it looks a little pink. And that's in part because of the background of the map. You have to come over to the key here where it's white and see that it is actually blue in color. Here's the frequency of those price reductions. So how common is it? So price reductions aren't very common. Only 15% of the sellers in all of Silicon Valley are doing price reductions. Santa Clara County is the highest at 16.5%. The least is Alameda County at only 12.1% of the sellers are doing the price reduction. Look at Berkeley and Alameda, only 5% of the sellers are doing price reductions in that area. That's 1 out of 20 sellers. What's the highest area out of curiosity? 21, 38, probably 38. In San Mateo County coast, it's over 1 out of every 3. It's almost 2 out of 5 are doing price reductions. This is the frequency of those price reductions compared to typical. I do need to go back and look at Foster City. I'm not believing this. I think somehow the formula got stuck at 0 because it's been read like that for more than 1 week now. But anyway, you can see the trend is the same. The market's definitely cooler than it typically is, although it's still a fairly strong marketplace. Here's the amount of overbidding. Here again, look at the amount of red. In order to be red, you have to be at least 1.5% overbid. And then look at Alameda and Berkeley, 26% over the seller's ask price on average. That means if someone's asking $2 million for their house, which is high for Berkeley and Alameda. So let's take a reasonable number. They're asking $1 million. They get $1.25 million. I mean, who would expect to get 25% more than they ask? And that's the average. Imagine what the highest overbids are. But again, you can see the amount of overbidding as far as magnitude is pretty high. The lowest overbidding is in Morgan Hill, South County, where they're actually taking 0.3% reduction. The San Mateo County coast is actually doing better than that right now with a 0.7% increase. So the only one below zero is the South County area of Santa Clara County. Here's compared to typical. So this again is showing you that the overbidding, although in my opinion still robust, is less than normal in a lot of areas. You can see you have Alameda County at 2% more overbidding than typical, and it's brought up mostly by Berkeley at 6% more and Oakland at 4% more. Even Hayward helps out at 2% more overbidding than typical. It's insane, you know. At least I expect to negotiate down price in real estate, but not in Silicon Valley. And I've been in the industry, and I'm used to it now, but it still strikes me as odd. The frequency of overbidding, how common is overbidding? A lot of areas are 2/3 of this area. Silicon Valley overall is 2/3. Santa Clara County is the worst performing right now at just under 2/3. San Mateo County is just over 2/3. And Alameda County is the strong one at 72%. That's approaching 3/4 of the sellers getting more than their asking price. And it achieves 3/4 in Fremont, Berkeley, and Alameda, the city of Alameda. 85% of the sellers are getting more than their asking price. Compared to normal, Alameda is down here at 2% more than normal. So it's an aggressively overbid area. And this is on the frequency. Again, you pretty much have normal levels of frequency. You got some cool areas in Santa Clara County. Again, Santa Clara County is the underperforming county at 90%. San Mateo County is almost at 95%, and Alameda County is over 95% of overbidding compared to normal, which is a little bit less. You know, if you're only at 95%, that's less overbidding than you normally do. 100 would be normal amount of overbidding. This is looking at offers compared to the 10-year median. I want to stress that there is no offer raw count. And the reason for that is each micro market area is a different size, and the raw count by itself wouldn't make any sense. But you can see it's blue overall, and there's some areas of green. But you come over and look at the range. Silicon Valley is 85%. Santa Clara County is actually doing fairly well on this metric at 94%. San Mateo is doing the best at 95%. The county that's hurting on volume of sales is Alameda County. And that almost doesn't make sense. It's got some of the most aggressive overbidding, but it's got the least amount of the activity that it does compared to the 10-year median. The only explanation I have from that, and I don't have data to back it up, is sellers are coming on the marketplace, misreading the marketplace, having to take price reductions, overshooting where the market is, and then the buyers come in and overbid their new reduced ask price and sell the property. That's the only thing that makes sense for them to have reduced volume of sales and more overbidding. Here's the same thing with active inventory for the exact same reasons. I only have comparisons. And again, you can see there's more inventory. More inventory favors the buyer. That's why all the colors are green to blue. Green is the range of balance right around normal. And that would be anywhere from 12.5% below 87.5% to 114.3%. So you have quite a bit of range on the volume of transactions to be normal. Here's appreciation since the last 9 months of 2015. Red is simply the areas that have the most appreciation. Blue are the areas that have the least appreciation. You can see it's sort of the close-in Silicon Valley areas that are more affordable that have done the best. Most of this difference in appreciation has occurred since 2020 with the pandemic. Here's the price range, and like most people, I follow the median in the middle, but I also follow the cheapest 10 percentile in each area and the most expensive 90 percentile. And that is nice because now you have a range of what areas. And again, here, color is simply not market conditions, but the most expensive, the least expensive. So the most expensive area is Atherton, Menlo Park, Portola Valley, and the least expensive is Hayward, San Leandro, and San Lorenzo. Those three communities have the lowest price, lower than Oakland, but that's based on the median. So if you look at the median, there's a $50,000 low or 55 in Hayward. But now if you look at the low end, you can get a lower priced home in Oakland than you can in San Leandro, San Lorenzo, and Hayward. Here again is a summary we talked about at the beginning. Here's some definitions as we look at Silicon Valley data compared overall. So the purple is the current data here this week right here, and this is the turnover time. You can see we've been climbing basically since midway through first quarter. So we've been climbing now for 90 days, 13 weeks, but we're normally rolling over about now in the slow marketplace. The median number is still climbing. So we're sort of following the median at a higher level. The reason the median or the 10 percentiles are more fluctuating like this is because you're looking at the extremes. And so they go slow down more and they speed up more. And that's why there's more fluctuation. The gray line is more where you'd expect the data to be. The purple line is going to tend to follow the shape of the gray line versus the shape of either the blue line or the red line. Here's the marketing time compared to normal. So you can see that you're 35% or so slower than normal. You can see that we were slower about 3 weeks back, 1 week there, 2 weeks there, and 3 weeks here. We're coming off, because up here you're getting close to record slowness compared to typical. We're improving. Which direction that goes in the future is anybody's guess. Here's the marketing time. This one, you can tell that you're most likely to increase. In fact, the fact that we were exactly flat from last week's unusual. You might say, well, we got a little plateau here, and now we're going to start climbing rapidly because we were climbing rapidly back here when the gray line was fairly flat. Now the gray line gets steeper. We may see some fairly increased marketing times. And this, again, is the time it takes 3 out of 4 sellers to successfully sell their house. This is more optimistic than turnover time because it doesn't include the sellers that are unsuccessful in selling. Here's compared to normal. So you can see that we're unchanged from last week at basically 41% longer than normal. But again, remember what was that, 23 or 24 days on there? So it was not a very long time, just over 3 weeks. I like this metric. It's the 97.5th percentile, the sellers that are taking the very largest price reductions. How big of a price reduction are they taking? Almost 12% reductions from where they originally set the marketplace. Normally, you're up here at somewhere around 9.5%. So those numbers are much bigger than you expect, and that's because the vast majority of the sellers are doing a no price adjustment at all. The other thing, just as a professional observation, is I find even a 2.5% price adjustment is a completely different marketplace. So it's hard for me to imagine misreading the marketplace by 12%. Maybe it was someone knowingly testing the marketplace, because I did have one client that was a good client that I did that for. I regretted doing it, but I did it. And it just took forever. And I believe that particular seller ended up getting less than they would have had they priced the home correctly to begin with. Here is the average price reduction. So you're looking at the average. You can see it's much more reasonable number, just over 1% of the seller's ask prices coming off. And that's what the sellers reduce. You can see all 3 lines are increasing price reductions. Here's no price reduction up here, 3% down here. So you can see a 2.5% price reduction is huge on the average. It's not huge at all on the individual sellers that are doing the price reductions. Here's compared to normal. You can see the amount of price reductions has actually been decreasing, sort of following almost the same pattern that we did last year. Here's the end. Here's April 1st on the vertical line. So we're somewhere right about here and we're climbing back up. So we're better than we were last year and going in the same direction. So that would almost suggest that there will be less price reductions going forward. We'll find out. Frequency of price reductions, not even 15% of the sellers are doing price reductions. So that's about 1 in 7 of the sellers are doing a price reduction. And that's pretty, and that's actually pretty accurate, because 14% would be fairly close to 1 in 7, and this is just over. So basically 1 in 7 sellers are doing a price adjustment, which means 6 out of 7 sellers are not doing a price adjustment. Here's frequency compared to normal. You're 38% more price reductions than normal. Normal would be right here on the gray line in a straight line. So you can see that's why this is shaded blue up here. Anytime the data line gets up in that shaded, you're cooler than normal. When you're down in the red, you're hotter than normal. So even though we were having the price adjustments and we were only selling 80% of the marketplace, we had periods of time in the recent past after the 2022 price correction, which is this big drop off right here. Look at that. Talk about a steep drop. You had hot periods where sellers were doing very little price adjustments. For right now, last year, there was a fairly long period of time when they were taking more. We're right now in that period as well. Here's median overbidding. So this is the only slide I have it, and I guess I was right at 4% overbids. That's the median. The average was what, 7.4 or 7.7 or something like that. So the average is much higher. This is comparing the overbid compared to normal. So that's a 0.5% more overbidding than normal. So if you're at 7% overbid now, and this is average overbid. So if you're at 7% typical, you're at 7.5. So it's probably was. Here's the frequency of overbidding, just under 70%, right at 2/3 of the sellers are getting overbid, so fairly common. I think I said earlier that Santa Clara County was the least amount compared to normal. You're only at 92% of the amount of overbidding you would expect, so less frequent overbidding, fewer sellers than expected are getting that overbid. Offers accepted, you're sort of in between the cool range, the blue line, and the normal line. You're sort of following that blue trend. You had a little V here, which is probably exactly Easter climbing. We're about at the peak. Remember that I said that earlier that the peak is typically the Friday before Memorial Day. That's just next week. So we may go up one more week, and then you can start expecting to see the number of offers declining. Here's active inventory. Same concept. You're climbing. The active inventory typically peaks right around July 19th. You can see on the gray line, you're past July 1st, but that's typically right around July 19th. We're still climbing. I'd expect this to climb for several more weeks. Here now is looking at the appreciation. It's interesting that the cheapest homes have had the worst appreciation. The moderate price, the medium priced homes have had the second, and the expensive homes have now had the most highest appreciation. That ties in directly with the K economy people. Here's the three models. Again, the pricing of the expensive 90% homes is continuing to climb. The median is basically flat. And I would almost say there's a slight downturn in the 10 percentile. And the reason I'm saying that is your price right now is below the horizontal line. It didn't cross over at all last year. It barely crossed over 2 years ago. And 3 years ago, it did not cross over. So I think that this line has to go slightly downwards, but I'm going to wait and get more data before I move it off of horizontal. Here's the payments. It also takes into consideration interest rates, and I use the high balance conforming loan limits that's published by the Federal Reserve Bank out of St. Louis as the national average. So you can do better than that by getting jumbo money, which is typically, but not always, cheaper than high balance conforming money. And also by having relationship pricing. If you have a retirement fund, that you can move your stock to the same bank, the brokerage associated with the bank that you're getting the loan through. Some quick definitions. Turnover time for the 3 counties. So now what we're doing is we're going through the exact same metrics, but instead of looking at Silicon Valley as a whole, we're going to try to look at the 3 counties individually. You got Alameda County in the gray, Santa Clara County in the blue, and San Mateo County in the orange. You're looking at supply-demand ratio. The turnover time is the slowest in Alameda County at 48 days, Santa Clara County at 43, and San Mateo County is the fastest at 38 days. So that's a little bit less than a month. That is fast-paced. Even for California, I think CAR says from 3 to 10 months is normal. I normally see 4 to 12 months or 4 to 10 months for the nation for turnover rate. I use days instead of months because they're so small. Talking about fractions of a month, talking about days or weeks, to me makes more sense. Actually, talking about weeks would probably make the most sense because real estate has such a weekly impact, but it's pretty easy to divide by 7. This is the time for the typical seller to sell. So this is 3 out of 4 sellers are selling. All of us are selling fairly quickly, 20 to 23 days. So in my opinion, you cannot complain about selling a home in 3 weeks. Sellers price reductions. You have the least amount of price reductions in Alameda County. That's surprising. That's not what I thought I saw earlier. The most in Santa Clara County and the second most in San Mateo County. The Alameda County isn't doing price reductions along with getting the overbid, but they have long marketing times. Interesting. Frequency of price reductions, least frequent in Alameda County, most frequent in Santa Clara County at about 17, just under 17%. Overbid, look at Alameda County. It shines. It's up over 11% overbid. San Mateo County is next at just under 7%, and Santa Clara County is in last place at 4.5% overbidding. I mean, that's a respectable overbid. If I'm asking $1 million and someone gives me $1,045,000, you'd think I'd be happy. But it is what it is. Santa Clara County has been doing about the second for the most part, mostly in the second position, and the last year was tied for third. So for it to be on the bottom is not unusual, and even back over here, it was on the bottom for a lot of the time frames. Maybe Santa Clara County isn't the best performing. For a while there, I thought it had been. Frequency of overbidding, Santa Clara County has the least frequent overbidding at just under 64%. The most is Alameda at 72% of the sellers getting more than their ask price. This is the offers accepted. Santa Clara County has the most offers accepted. Alameda County is normally closer together with Santa Clara, but right now is not. And San Mateo County is the least, but that's because it's the smallest area. You can sort of get an idea when you come back and draw a horizontal line. It's sort of reasonably producing compared to the 10-year median. But noteworthy is it's higher for San Mateo County than in the past 3 years. So San Mateo County is sort of doing a little resurgence. Alameda County is sort of right even, and Santa Clara County is more like San Mateo in the fact that it's got the largest number of volume of offers accepted, except for a brief period in 2024. So that's noteworthy. Active inventory, Santa Clara County's got the most inventory. Alameda County is close behind, both right around 1,200. And then the least amount of inventory is San Mateo at about 540. And again, that's based on their size. Here's the appreciation. Santa Clara County has the most appreciation, and I haven't talked about it yet, so I'll do it now, even though it's not the best slide to do it. Santa Clara County has the highest appreciation, but that's because our expense areas, those Los Altos, Palo Alto, Saratoga, were making up a larger percentage of the market share, which are more expensive homes, which raises the median for the county, but does not raise the median or the value of any given property. Then San Mateo County is in the middle, and the least amount of appreciation is Alameda County at 85%. Here's the sold price on log paper. This is nice, so you can see trends like flat here for Alameda County, but easier to read the numbers on the regular paper. So you have San Mateo County at about 2170 on their median ask price. That's 2,170,000. Santa Clara County is about 2 million, call it 2,090,000. And then Alameda County is down at 1,360,000. Here's the payments going through the same formula. It assumes an 80% loan with an estimate for property tax and insurance. Here's the raw sales. It's getting less interesting when you're down here numbers around 6, but you know you're only 45% above the 25-year low. But the 25-year low is artificially low because of the pandemic. Here, only 1,600 homes. You can see your second lowest year was 2000, so you were 20% slower. What probably makes more sense is compared to the median, and we're at 85%. And that reminds me that just last week, these numbers were 90. What gives, Richard? Well, it's complicated, but let me try to explain. Microsoft, when you do the ranking here, requires you to include the current year in your account. I like to not have the current data influence my median, so I use the -1 over. So we're so close now. We've had 4 years past the pandemic. That 1 year shift, including 2026, changed the median drastically and made it 90%. So it went from 80% to 90 just based on what 10-year period of time I was using for my benchmark. I can't change the Microsoft formula. I think it's better, cleaner when you say, how's this year comparing to the past 10 years? It's the past 10 years, not the current year plus the past 9 years. That's just my opinion. I like my opinion. I'm not going to change it. I wish I could change the Microsoft formula. But anyway, that is why these numbers were done. I did the slide early in the progressions. I did include the current year last week and historically because I wanted to be consistent. But now I want to be consistent with the rest of my presentation. I will just have to try to remember the ranking here includes the current year and goes back 24 years. Anyway, here's the raw count for Silicon Valley, Santa Clara, San Mateo, or Alameda County. You can look up whatever metric you want. I do want to point out that this is the appreciation since 2020 with the pandemic. So you can see Santa Clara County's had 53% appreciation, where the other two counties are basically 35% appreciation. So Santa Clara County has really shined compared to the other two counties post-pandemic. And it's that difference that impacts the 2015 appreciation up here, where both San Mateo and Alameda are very similar, about 85% appreciation, and Santa Clara is at 218%. Here's some definitions for the distributions. We have three distributions we're going over. The first one is marketing time. You start off here, and I cut this off at 50 percentile because there's very little difference here in the marketplace. You're plotting the difference over here. So 90% of the sellers, the purple's current line, are selling in just over 40 days. That means only 10% of the sellers take longer than 41 days to sell their properties. We're starting off on the purple line. We go 1 week at a time for 5 weeks, then we go 2 weeks at a time, and then we finish up at 1 week at a time. A couple key points. You want to see what direction the dotted line moves. You want to see when the dotted line peaks and when it valleys. And also the green line right here, see how steep that is? That's an improving marketplace. Even though the line may go down, when that line starts getting flat, you're already slowing down. It just isn't reflecting. So let's start in. We're starting off on the dotted line on May the 17th, 2025. And since I said May 17th, how can I use May 17th when this is the 16th? I use a calendar year that's explained at the end of the presentation. And that calendar year, normally I report the data on the 17th. The data doesn't really change much from the 16th to the 17th. I like presenting this data on the Saturday because you can see what happened on the preceding week. That's why, and for the first data slide, so for the purple line, I'm actually including one extra day in the back because I don't have today's data yet. I couldn't have today's data until tomorrow, and that's a long-winded explanation. Let's start going through. Notice how the dotted line immediately started to go up. So that's saying that you should expect longer marketing time going forward all the way, and now you're expecting longer and longer marketing time until the dotted line changes direction. We're now in the middle of July, beginning of August, plateaued for August, basically plateaued in there, and climbed to the middle of September. Huge improvement in the end of September, improvement in plateaued, probably reverse direction going into November. Now it will continue to climb all the way through the end of the year. January 3rd, right there is probably the slowest. Now you're already improving because notice the left-hand side improved. Look how steep the green line is. Already flattened, even though this part of the line didn't improve. So that was already getting worse. And then you're climbing. So that was about March the 1st was the fastest marketing time you expect. Now we're moving on to price reductions. This is the distributions. The dotted line is a year ago, and that's where we're starting off. Purple line's very close, but what direction do the dotted lines move? They're getting worse. They went down quite a bit, down, down. So right there was a little bit of a level, down, down. So basically the markets, there's maybe the bottom on July 19th, slight improvement on August 2nd, improvement. So between now and August 19th, I think it was, you'd expect prices to decline. Now you're having a little bit of a resurgence and less price reductions right there in the September, October timeframe. And now we hit November and you expect more price reductions. Watch what happens in December. That may be the low on December the 6th. Nope, the 20th. January 3rd really wasn't noticeable. There's a huge reduction, and that's close to the peak. There's probably the peak for that year on March the 1st. Now you're going to be slowing down for the balance of the up till current time frame. So basically, we'd expect for the next foreseeable future for sellers to take more and more price reductions going forward. The other thing that's nice about this is to show people that, a 2.5% price reduction is huge because so few people take it, and that's sort of one of the things that buyers don't understand is buyers don't go in and offer below ask price. Here's overbidding, same concept, purple line. Look, this is what's pulling up, and this is almost the K economy again. The high end is doing very well. The bottom end is doing the same as it did last year. Let's step through and see what happens. It looks like we have maybe one more week at the high and then we start going down and we just go down. This is delayed and that's why the pattern is still one more week of before it going down. And it's also a different pattern. It's more subdued because people take different lengths of time to close. There's the bottom on August 30th, and that was the worst line for the entire year, not at the end of the year. Now it's getting improving, middle of October, end of October, and now there's the beginning of November, and now it's going to reverse and come down for the end of the year. But notice right there's sort of the end of the year, and there's January 3rd. It's above where we were back in August, whatever date frame it was. So is that line. So the least amount of overbidding doesn't necessarily happen at the end of the year. There's sort of the maximum overbidding on March 29th, and you have to subtract off about 35 days from that, which puts you back into February for the peak amount of overbidding on terms of offers. Now you're slowing down. So again, we're sort of at or about approaching the peak of the marketplace. Now we're going to go into the Greater Bay Area. These are some definitions. Here, the purpose of this is to show you what's happening overall. Silicon Valley is climbing. The cities is going the other direction, and all three other regions are going the other region. So the only area that's having longer turnover time is Silicon Valley. It's slowing down where the other four regions are all improving, which is interesting. Time to sell. Here, the cities is also increasing with Silicon Valley, but so is North Bay, and the other two are flat. So totally different reading of the marketplace between turnover time, the theoretical time, and the actual time for sellers that are successful. This is more optimistic, even though the marketing times are increasing. It sounds strange, which is one of the reasons I do so much data. Here's the price reductions. You have price reductions going down in 4 of the regions and flat in Santa Cruz. And Santa Cruz, Monterey, it's more fluctuating because it's a smaller area, but all regions are going down or having increased, not price, but increased price reductions. So they're increasing the amount they're reducing their price before the offer comes in. Frequency of price reductions increasing in all 5 regions. No question about that. Still very low numbers. The highest number is 25% of the sellers are doing a price reduction, and the least is at 11%. So low numbers, but all increasing. Amount of overbidding. The highest amount of overbidding by far is the cities at almost 18% over the seller's ask price. That's approaching 20% overbidding. And it's the highest level. It's back to the level where they were just before the 2022 market correction on Valentine's Day, in my opinion, because your end of first quarter, subtract off 45 days, you're right there at middle of February. Anyway, that's interesting that that's up. The Silicon Valley is basically on a downward trajectory, even though this last week went up. North Bay is basically flat. Santa Cruz is down, and Central Valley is still in climbing. So definitely mixed news on the amount of overbidding. The frequency of overbidding, you're coming down in Silicon Valley, so less overbidding in Silicon Valley, going up in San Francisco, Marin's, the cities, going up in the North Bay, flat in the Central Valley, and probably flat or going down in the Central Coast. Offers accepted, going up in all regions. You'd expect that, and it continues for at least probably one more week before we see a reversal. Number of active inventory climbing. This will climb again until middle of July, so climbing in all the regions. Appreciation, Silicon Valley has the highest appreciation. Looks like Central Valley is next, Central Coast, cities, and in last place now is the North Bay with the least amount of appreciation. Still 65% appreciation in 10 years, which is not bad in my opinion. Here's the price, and I didn't adjust the horizontal lines, but they're pretty close. Prices are going up in cities, flat in Silicon Valley, coming down in the Central Coast, flat in the North Bay, and flat in the Central Valley. So overall flat on pricing. This is the estimated payments, the exact same pattern and order because it just goes through a mathematical formula. The reason the pattern's the same is the interest rate from last week to this week only went down 1/100th of 1%. Here's the raw data, and that it is the 17th. You have the now column, which is the current data. 1 week ago is the change from a week ago, the change from 5 weeks ago. You have the Silicon Valley or the regions, all 5 of them. I have a bonus region of the Bay Area, which I think is a completely garbage number. I include that because that's what the media talks about a lot. And, you can see it for yourself, it's garbage number. Just pick any metric, 44 for the turnover time or time to sell. And that ranges anywhere from a low of 32 days to a high of 63 days. And, how 44 represents that is irrelevant. And you don't have the graph to show the trend, but it's it's why I got into micro market data. Real estate is local, and what's happening in Saratoga, Las Gatos right now is different than what's happening in Milpitas. Two different marketplaces, even though you're even in the same county. Here's my week calendar year. I start on March the 1st, basically, because of leap year. I work through 7 days at a time, all the way up until February 21st. Then I jump forward 8 days